Folks, all the indicators are pointing in the right directions. Your charts are pointing green. Everything is pointing to a bullish market. You've got the perfect stock. You've got the perfect setup. The question is, debit spread or credit spread? That's what we're going to talk about in today's video. Now, each is very, very different, but they're entirely similar, and I'm going to explain to you when you should initiate a debit spread or a credit spread when you're trading directionally. Let's get into it in today's video. If you still need help after watching this video, use the button below to learn my strategy. It can help you potentially score a 40% profit in 4 days trading option spreads with over a 90% chance of profiting each time you initiate the trade. Yes, folks, seriously. Click below and I'll tell you all about it. Now, let's get into today's lesson. So, what's the big deal between debit spreads and credit spreads? When do you initiate a debit spread? When's the best time to initiate a credit spread? Just talking about it makes me dizzy. All right, I'll make it really, really simple for you. The best time to initiate a debit spread, and I've broken it down, I'll show you everything, but let me talk about it for a minute. The best time to initiate a debit spread is when you're expecting an explosive movement, a lot of movement, debit spread. When do you trade credit spreads? When you expect congestion, trading range, lack of movement. Now, stock markets are range bound, meaning they don't do anything about 75% of the time. For example, last few months we've had very, very little directional movement, very little momentum, and we've had a lot of choppiness. So in a choppy market environment, a credit spread is your best friend. In a raging bull market, a debit spread is your best friend. Now let me give you two examples so you understand the difference. In a debit spread, let's say the stock price is $70 a share. Let's say the stock is trading here. Stock is trading at $70 a share. And you believe the stock is going to go to 100 for a minute, all right? You buy the expensive option. See $3 signs, and here there's only $1 sign? You buy the 70 call. The 70 call is always going to be more expensive than the 75 strike price call. It's closer to the money. Stock is 70. 70 call, more expensive, okay? $3. So in a debit spread, you buy the expensive option and you sell the cheaper option. And your profit potential is the difference between these two strike prices. So you have a $5 profit potential. That's a debit spread. Now, let's change the scenario a little bit. Just a little bit. Let's say that the stock market, let's say that you think the stock, the $70 stock, has petered out. It's done. It's not going anywhere. It has peaked out, so to speak. And let's say you're expecting it to either go lower or to just kind of do this. Kind of just drift. That's what stocks do most of the time, right? They don't really move up and down all the time. They move up a little bit, they move down a little bit, and then they drift. All right. So, what you would do is the opposite of a debit spread. You would sell the expensive contract, the 70, and you would buy the 75 as a hedge because you don't know what's going to happen. You have no idea. What if you're wrong? What if this market explodes? You want to have a little hedge, right? You want to protect yourself. Okay, so debit spread, you buy the expensive option, you sell the cheaper option. Credit spread, you buy the cheaper option and you sell the more expensive option. Now, why would you do that? Well, if you sell the more expensive option, see more dollar signs here? It's more expensive. You get money for it. You get income. And since stocks are doing this 70% of the time, this becomes very valuable. You get income right away. And if you're wrong, your max loss is the difference between these two strike prices. Here, your maximum profit potential is the difference between these two strike prices. Here, your maximum loss potential is the difference between these two strike prices. But you get your premium right away. So let's say, for example, that the 70 costs $4 and the 75 costs, let's say, costs $2. Okay? That $2, here it's a debit, minus $2. That's what you have to pay. Here, it's a credit spread. The $2, it goes right in your pocket. So, expecting a major move, a big move, earnings, takeovers, raging bull market, debit spread. Expecting congestion, sideways trading action after earnings, when markets are a few weeks before a Fed announcement. You know what I'm talking about. Credit spread. All right? Options, it's like buying ice sometimes in the right environment. It just melts. So credit spreads work really well in the right environment. Hope that helps. Now, let me show you how to use option income spreads that have generated consistent income over the last 20 years with extremely low risk. It's a great way to help you earn reliable, steady income month after month. Click the button below to continue. I'll see you there.